I'm afraid to say that the only way you actually learn from the investment mistakes is by making them yourself.
Welcome back to Breakout with Breaking Views, brought to you by PGIM. I'm Peter Fellarson, the acting global editor of Breaking Views in London's Canary Wharf, and I'm talking again to Edward Chancellor. Eddie, welcome back. This week, we're talking about investment mistakes, a seemingly inexhaustible subject. Eddie, you've written a lot about speculative follies over the years. So what's prompted you to return to this painful topic?
Well, last week in Edinburgh, a friend of mine, the investment strategist Russell Napier, opened a new library, a business and finance library in Edinburgh, which he calls the Library of Mistakes. And the library was opened by Alistair Darling, who, as you know, was Chancellor of the Exchequer at the time of the financial crisis, when a whole litany of financial mistakes was made. So I thought that would be a sort of interesting thing to talk about.
Yeah, and why? I mean, it sounds like there's a lot of discussion there, but why is it so important, do you think, to study investment mistakes?
Well, I mean, you can study them historically. Investors have been doing foolish things since the tulip mania of the 1630s through to the current day. So that's a useful source of information. That's what Napier is trying to do with his new library, provide a resource. But I'm afraid to say that the only way you actually learn from the investment mistakes is by making them yourself. And the trouble is that many investors sweep their mistakes under the carpet, don't like to fess up to them, and don't learn from them properly. I cite what I think is an example of best practice, where the British fund manager Richard Oldfield, who's got 40 plus years of investment experience, writes in his very entertaining book, Simple but Not Easy. He opens the book with a whole chapter on his personal investment, what he calls howlers. And I also write about George Soros. And Soros is, I think, particularly interesting in this respect, because Soros has a whole philosophy that you cannot really know what's going on in the investment world, that all our knowledge is imperfect. And what Soros says about his own investment practice is that he has always tended to just take a bet on a hunch and then sit back and say, what have I done wrong? Where is this to go wrong? So all his investment effort has gone into identifying errors. And as Soros says, apart from identifying and rectifying errors, the business of investment is actually pretty easy. And I think Soros is right, although I don't think one would recommend just, following his course. He's a highly engaged, he was very leveraged, Soros, and also had very high turnover. But his principle of actually thinking the whole time about his errors was, I think, the source of his multi-billion-dollar fortune.
Yes, well, I suppose the point about being an investor, as you say, is that you're making mistakes all the time. I suppose the trick is to make fewer mistakes than you have successes. But I guess, I mean, sort of turning to things now. I mean, you would think that with this experience and with the advice from people like Soros, that maybe there might be some sense of progress in this. But you have a great line in your piece from James Grant, the publisher of Grant's Interest Rate Observer, where he says, progress in physical sciences is linear, in finance it is cyclical. So are we just doomed to repeat our mistakes over and over again?
As Jim says, we keep on standing on the same rakes. And now, what were the rakes that we saw, that we stood on during the financial crisis? Well, they were really to do with liquidity, dependence on liquidity, and ignoring high leverage. And now, a lot of funds blew up, a lot of banks went down. So you'd like to think, well, perhaps you've learned a thing or two from that. Then you look, and I write about this in my piece, think about the recent investment catastrophes of the last few years. And I cite Neil Woodford, who had been a star fund manager in the City of London for a long time, started his own fund got stuck in a number of illiquid, unlisted securities and had to close his fund down because he couldn't meet redemptions. The year earlier, Global Asset Management, a very respected firm, established firm, had similar problems with one of its fixed income funds. So the problem of illiquidity is there. And then, of course, there's a problem of leverage. Now, in the US, the New York Stock Exchange published data on margin loans, was trading at all-time highs, and anyone could get a margin loan from Robinhood at a 2% interest a couple of years ago. And then we have, the ongoing scandal of Bill Huang of Archegos Capital, who borrowed billions of dollars to take highly leveraged positions and appears to have lost his lenders $10 billion. So I'm thinking, well, what did they learn from the previous experience? And the answer is nothing. And there's one other error I'd say, is that leading up to the financial crisis, there was a lot of what we call yield chasing, taking too much risk in order for a small increment of yield. And we've seen that happening a lot in recent years too. So I'd say that looking back over the last 2 or 3 years, and I've obviously written a lot about it, there are more errors compressed into the market activity of the last couple of years than one has seen, I think, almost at any other time in history.
Well, and I suppose you then sort of wonder why that is, and you suggest that part of this is just a question of incentives, that actually to sort of you're better off being wrong as a group than standing out and being right, but having to wait a long time for that to happen.
Yeah, I mean, if you work for a professional investment firm, you have to sort of track, you get daily records of how your fund is doing relative to the market. So when the market goes into sort of bubble mode and you start underperforming, there's a huge pressure to even go against your better judgment. So that's one reason why some of the a lot of these classic mistakes are being made. The other I point out, and this is again something I write about a lot, is that the extraordinary monetary policies of the last decade or so seem to have induced a collective amnesia in the investment world. And why is that? Well, you can think of it in several ways. One is that by lowering volatility and keeping interest rates low, they have actually, the central banks have boosted market valuation. So they've created the bubble conditions. But also by keeping interest rates low at zero levels, they encourage and they force people into the desperate search for yield. And finally, and this goes back to Archegos, is the very low interest rates actually induce leverage. So you could say that although making mistakes is human nature, the conditions for making mistakes have been made rife by the central bank policies.
Yes, well, and as you say, sort of interest rates are now going up, and sort of liquidity is becoming a bit less plentiful. So that would suggest that some of these, if you're right, some of these investment mistakes are going to come to light, and we will have new books and new volumes to add to the library of mistakes. Eddie, great as ever to talk to you. Thanks very much, and we'll be back again soon.
See you soon. Bye then.